Something extremely dangerous just happened in global finance, and almost no one in America is talking about it. While most people are watching the Fed, elections, or the stock market headlines, the real trigger is thousands of miles away in Japan. And what started there is about to hit your money, your investments, and the entire US financial system harder than most people expect. Before we go any further, if you want clear, no-nonsense breakdowns of what's really happening in the global economy and how to protect yourself, subscribe to Capital Pressure right now. We post deep analysis like this every week, and you do not want to miss what's coming next. Now let me explain why this matters so much. There's a concept in chaos theory called the butterfly effect. A small event in one part of the world can trigger massive consequences somewhere else. In finance, this isn't theory, it's reality. And right now, that butterfly is flapping its wings in Japan. For the first time in over 2 decades, Japan's 30-year government bond yield has surged to around 3.5%. The 10-year yield has moved above levels last seen in the late 1990s. To the average person, that sounds boring. Just another bond yield, right? But to the global financial system, this is a structural break. A line that was never supposed to be crossed has just snapped. Japan has been the foundation of cheap money for the entire world. For more than 20 years, Japan kept interest rates near zero, sometimes even below zero. That made the Japanese yen the cheapest funding currency on the planet. Trillions of dollars were borrowed in yen and sent into US stocks, US real estate, US bonds, and even crypto. This wasn't speculation. This was plumbing. It's how the system worked. Hedge funds, banks, and institutions borrowed yen at almost no cost, converted it into dollars, and bought higher yielding assets in the United States. The difference was pure profit. Free money, as long as Japanese rates stayed low and the yen stayed weak, but that game just changed. When Japanese yields rise, the cost of borrowing yen explodes. Suddenly, those safe leverage trades stop working. Even worse, if the yen strengthens, borrowers owe more than they originally borrowed. That's when leverage turns from a gift into a weapon. And that's exactly what's happening now. This isn't about fundamentals. It's not about earnings or economic growth. This is mechanical selling, forced selling, margin calls. When leverage unwinds, assets get dumped, not because people want to sell, but because they have to. This is where it gets even more serious. Japanese pension funds and insurance companies are some of the largest investors in the world. For decades, they were forced to send their money overseas because they earned nothing at home. They became massive holders of US treasuries, European bonds, and Australian debt. But now, for the first time in a generation, they can earn real yield inside Japan. Around 3.5% with no currency risk, no geopolitical risk, and no need to chase returns abroad. That changes everything. For years, Japanese institutions openly said that if domestic yields crossed roughly 3%, they would bring their money home. We're now well past that level. That means repatriation has begun. When Japanese investors sell US treasuries, yields in the US rise. When yields rise, mortgage rates rise, credit tightens, banks feel pressure, the US government's interest costs explode. This is a rate hike for America that the Federal Reserve didn't vote for. And here's the nightmare scenario. The United States runs massive deficits, trillions of dollars. The Treasury depends on foreign buyers to absorb that debt. China has already stepped back. Now Japan is stepping back too. So who buys the debt? If foreign demand disappears, yields spike. And if yields spike too far, the US government becomes mathematically insolvent. At that point, the Federal Reserve has no choice. They step in as buyer of last resort. That's when the printer turns back on. This is how yield curve control begins. The Fed draws a line in the sand and says, rates will not go higher than this. And to enforce it, they print unlimited dollars to buy bonds. That's not fighting inflation. That's surrendering to it. And every time central banks surrender like this, trust in paper assets collapses. We've seen this movie before. In 2008, silver crashed during the liquidity panic. Then the Fed printed, and silver went up 5 times. In 2020, silver crashed again, then doubled in months after stimulus hit. Crisis first. Printing second, explosion third. We are now at the crisis stage again, but this time from a much higher starting point. This is why silver matters. In the early phase of a liquidity shock, everything gets sold, even gold and silver. People sell what they can to cover what they must. But once the panic settles, capital looks for safety, and bonds are no longer safe. Cash is being diluted, currencies are unstable, hard assets become the exit. Silver sits at the intersection of money and industry. It has no counterparty risk, no yield curve risk, no central bank attached to it. A silver coin doesn't care what the Bank of Japan does or what the Fed promises. At the same time, industrial demand doesn't disappear. In fact, a stronger yen increases purchasing power for Japanese manufacturers. Electronics, solar, automotive, all depend heavily on silver. So silver gets hit from both sides, monetary demand and industrial demand. Now add banking stress on top of that. Banks facilitated this entire carry trade. They lent the yen. They provided the leverage. If hedge funds blow up, losses don't disappear. They move up the chain. Prime brokers get hit. Balance sheets weaken. Credit tightens. And when banks wobble, central banks panic. The Fed may talk tough, but history shows one thing clearly. When inflation fights financial stability, stability always wins. Rates get cut. Liquidity returns. Printing resumes. That's why this isn't just a Japan story. It's a global reset of how money flows. The era of free leverage is ending. The era of forced printing is beginning. And that combination has always been explosive for silver. Now listen carefully, because this part matters for you. This path will not be smooth. There will be violent drops, sharp shakeouts, days where silver falls hard and fear is everywhere. That's how weak hands are forced out. That's how paper positions get crushed. But physical ownership is different. Unleveraged ownership is different. The people who get hurt in volatility are the ones who panic. The ones who survive are the ones who understand the cycle. So if this breakdown helped you understand what's really happening beneath the headlines, comment below and let me know your thoughts. Share this video with someone who still thinks Japan doesn't matter. And make sure you're subscribed to your channel name, because this story is not finished. The butterfly has already flapped its wings, the liquidity storm is forming, and silver is standing directly in its path. Stay alert, stay informed, and I'll see you in the next video.